Learning Module, Portfolio Risk and Return, Part 2. Topic: Return Generating Models. An asset's variance attributable to firm-specific factors plus its variance due to market-wide factors equals the assets. A. Total standard deviation. B. Total variance. C. Systematic beta. When estimating the market model, the parameter that measures an asset's average return independent of market movements is the A. Slope. B. Intercept. C. Error term. In a market model regression of a stock's returns against the market's returns, the estimated coefficient on the market return variable represents the stocks. A. Alpha. B. Beta. C. Residual standard deviation. Return generating models are primarily designed to A. Determine the optimal allocation of capital between the risk-free asset and the market portfolio. B. Forecast a security's expected return based on its relationship with market returns. C. Calculate the variance of a diversified portfolio directly from individual asset risks. A multi-factor model estimates expected returns using variables such as dividend yield, price-to-earnings ratio, and firm size. This model is best classified as A. Macroeconomic factor model. B. Market factor model. C. Fundamental factor model. Which of the following best describes a key characteristic of the single index model? It estimates factor sensitivities from theoretical equilibrium assumptions. B. It combines macroeconomic and statistical factors for return prediction. C. It partitions an asset's total variance into systematic and non-systematic parts. Market-wide variance equals systematic variance. Form-specific variance equals non-systematic variance. Their sum equals total variance per the single index model decomposition. Option A. Total standard deviation is the square root of total variance. Standard deviations are not additive. You cannot add them to get total standard deviation. The question asks about adding variances. Option C. Beta is a sensitivity coefficient, not a variance measure. It has no units and cannot be the sum of two variance components. The fundamental equation is total variance equals systematic variance plus non-systematic variance. This decomposition is additive only for variances, not for standard deviations or betas. In the market model, the intercept represents the asset's average return independent of market movements, the portion not explained by the market. Option A. The slope measures dependence on the market, systematic risk, not independence from it. Option C. The error term E captures random, period-specific deviations with a mean of 0. It cannot represent an average return. Alpha is the y-intercept when market return equals 0. Beta is the slope. Error term is the random deviation from the line, averaging to 0 over time. Only alpha measures consistent market-independent return. In the market model, the coefficient on the market return variable is beta, which measures the stock sensitivity to market movements. Option A. Alpha is the intercept term, the coefficient on the constant, not on the market return variable. Option C. Residual standard deviation measures the volatility of the error term, E, capturing unsystematic risk, not a coefficient in the regression. Beta equals slope coefficient, market return variable. Alpha equals intercept. Residual standard deviation equals dispersion of error terms, unsystematic risk. The question asks specifically for the coefficient on the market return variable. Return-generating models, such as market model, are statistical tools that forecast a security's expected return by linking it to systematic factors like market returns using alpha and beta. Option A. Capital allocation between risk-free asset and market portfolio is determined by the CML and mean variance optimization, not by return-generating models. Option C. Portfolio variance is calculated using covariance matrices among assets. Return-generating models provide inputs, beta, expected returns, but do not directly calculate portfolio variance. Return-generating models are estimating expected returns using alpha and beta. Portfolio weights, optimization. CML parameters, equilibrium theory. Portfolio variance, covariance calculations. Each serves a distinct purpose. Dividend yield, PE ratio, and firm size are from specific accounting or financial variables. Models using such inputs are classified as fundamental factor models. Option A. Macroeconomic factor models use economy-wide variables, such as GDP, inflation, interest rates, not from specific measures. Option B. Market factor models, such as single index, use only market index returns as the explanatory variable, not multiple from specific variables. The three model types are distinguished by their inputs. Market index returns, market factor model. From specific data, fundamental factor model. Economy-wide variables, macroeconomic factor model. The inputs determine the classification. The single index model's key characteristic is its variance decomposition. Total variance equals systematic variance plus non-systematic variance. This separation of risk sources is fundamental. Option A. It is an empirical or statistical model, not theoretical. Factor sensitivities, beta, are estimated from historical data via regression, not derived from equilibrium assumptions. Option B. It uses only one factor, market return. Models combining multiple factors, such as macroeconomic, statistical, are multi-factor models, not single index. Single index equals one factor plus variance decomposition plus statistical estimation. This decomposition explains why diversification eliminates non-systematic risk, but not systematic risk. Topic: Calculation and interpretation of beta. An analyst gathers the following data for 3 stocks and the market index. Stock P, standard deviation equals 30%, correlation with market equals 0.75. Stock Q, standard deviation equals 25%, correlation with market equals 0.80. Stock R, standard deviation equals 18%, correlation with market equals 0.90. Market index, standard deviation equals 20%. Which stock has the highest beta? A. Stock P. B. Stock Q. C. Stock R. Stock A, standard deviation equals 18%, correlation with market equals 0.85. Stock B, standard deviation equals 22%, correlation with market equals 0.60. Stock C, standard deviation equals 15%, correlation with market equals 0.75. Market index, standard deviation equals 12%. Based on the following data, which stock has the lowest systematic risk? A. Stock A. B. Stock B. C. Stock C. In the capital asset pricing model, CAPM, the beta of the market portfolio is A. Greater than 1 because the market is the most volatile portfolio. B. Exactly equal to 1 as it serves as the benchmark for systematic risk. C. Less than 1 to reflect a diversified portfolio's reduced risk. An asset has an annual return of 15.2%, standard deviation of returns of 22.0%, and correlation with the market of 0.85. The standard deviation of returns on the market is 17.5%, and the risk-free rate is 2.5%. The beta of this asset is closest to A. 0.92, B. 1.07, C. 1.21. Covariance between market return and security return 0.024. Correlation coefficient between market return and security return 0.4. Standard deviation of market return 0.2. The beta of security is closest to A. 0.6, B. 1.2, C. 0.48. A security shows a correlation of 0.32 with the market. Its return standard deviation is 18.60%, while the market standard deviation is 10.40%. The beta for this security is closest to A. 0.57, B. 0.32, C. 1.79. Beta is calculated as correlation of asset and market, multiplied by asset standard deviation divided by market standard deviation. Stock P has the highest beta. Beta measures systematic risk, sensitivity to market movements. Higher beta means greater volatility relative to market. The calculations show P greater than 1, Q equals 1, or less than 1, confirming P has the highest. Beta is calculated as correlation of asset and market, multiplied by asset standard deviation divided by market standard deviation. Stock C has the lowest beta. Beta measures systematic risk relative to market. Beta less than 1 means less systematic risk than the market. Stock C is the only one with beta less than 1, therefore lowest systematic risk. By definition, the market portfolio's beta equals 1.0 because it is the benchmark against which all other assets are measured. When calculating beta for the market against itself, the formula yields 1.0. Option A, volatility is not equal to beta. The market may have volatility, but its beta relative to itself is always 1.0. Option C, diversification reduces unsystematic risk, not systematic risk. The market portfolio still has beta equals 1.0 as the systematic risk benchmark. The beta formula confirms this mathematically. When the asset is the market itself, correlation equals 1.0 and asset standard deviation divided by market standard deviation equals 1.0. Therefore, market beta equals 1.0. Beta formula uses only correlation and standard deviations. Equals 1.07. The asset's annual return, 15.2%, and risk-free rate, 2.5%, are irrelevant for beta calculation. Beta measures systematic risk or sensitivity. Correlation and standard deviations are the only inputs needed. Beta greater than 1 means asset amplifies market movements. Beta can be calculated directly using the covariance method. Beta equals covariance of asset return and market return divided by variance of market return. The correlation coefficient is not needed when covariance is already provided. Covariance measures raw co-movement. Variance measures dispersion. Beta equals covariance divided by market variance. This method is simpler when covariance is known. The correlation 0.32 reduces beta despite the security's higher individual volatility. Beta less than 1 means less systematic risk than the market. Low correlation dampens the impact of the security's higher standard deviation on beta. Topic: Capital Asset Pricing Model, Assumptions, and the Security Market Line. According to the Capital Asset Pricing Model, CAPM, the variable that causes one asset's expected return to differ from another's is the asset's A. Unique form-specific risk. B. Sensitivity to market returns beta. C. Total volatility compared to the market. An asset is found to have a negative correlation with the market portfolio. According to the CAPM, this asset's expected return is most likely A. Equal to the market's expected return. B. Less than the risk-free rate. C. Between the risk-free rate and the market's expected return. In the Capital Asset Pricing Model, CAPM, the market risk premium is calculated as A. The expected return on the market portfolio. B. The difference between the expected return on the market and the expected return on the risk-free asset. C. The historical average excess return of the market over the risk-free rate. Which of the following best describes the security market line? SML. A. A line that plots expected return against total risk, standard deviation, for efficient portfolios only. B. A line that plots realized returns of a security against market, returns to estimate alpha and beta. C. A line that shows the relationship between an asset's expected return and its beta. In capital market theory, an individual stock that is neither overvalued nor undervalued will plot directly on the A. Efficient frontier. B. Security market line, SML. C. Capital market line, CML. Given the following security information and assuming the risk-free rate is 4% and the expected market risk premium is 7%. Security A, expected standard deviation 18%, beta 1.20. Security B, expected standard deviation 22%, beta 0.90. Security C, expected standard deviation 30%, beta 1.80. With respect to the capital asset pricing model, the expected return for security A is closest to A. 10.0%, B. 12.4%, C. 14.8%. Security B, expected standard deviation 28%, beta 1.25. Security Q, expected standard deviation 19%, beta 0.80. Security R, expected standard deviation 32%, beta 1.55. With respect to the capital asset pricing model, if the expected return for security Q is 10.2% and the risk-free rate is 4%, the expected return for the market is closest to A. 9.5%, B. 10.75%, C. 11.75%. Stock X, beta equals 1.1, standard deviation equals 18%. Stock Y, beta equals 0.9, standard deviation equals 22%. Stock Z, beta equals 1.4, standard deviation equals 15%. An analyst is comparing three stocks using the capital asset pricing model. Given a market risk premium of 5%, which stock will have the highest expected return? A. Stock X, B. Stock Y, C. Stock Z. An analyst is evaluating the sensitivity of three assets to changes in market expectations. Asset P, beta equals 0.5. Asset Q, beta equals 1.0. Asset R, beta equals 1.8. According to the CAPM, which asset's expected return is most affected by a 1% increase in the expected market return? A. Asset P, B. Asset Q, C. Asset R. The assumption of homogeneous expectations in the CAPM leads directly to the conclusion that A. All investors will hold a portfolio with an identical standard deviation. B. There is a single optimal risky portfolio that all investors will include in their holdings. C. The risk-free rate is the same for all investors. In capital market theory, if investors do not share homogeneous expectations about future asset characteristics, the most likely outcome is A. A single market portfolio that serves as the tangency portfolio for the capital market line. B. Multiple different optimal risky portfolios, one for each investor or group with unique expectations. C. All investors selecting portfolios with identical expected returns but varying levels of risk. The stock of Apex Industries has a beta of 1.20. The risk-free rate is 2.5%, and the expected market return is 8.5%. The expected return for Apex Industries is closest to A. 7.3%, B. 9.7%, C. 10.9%. A security has a beta of 0.90. The risk-free rate is 4.0%, and the expected market return is 9.0%. The expected return for the security is closest to A. 7.5%, B. 8.5%, C. 10.0%. In the CAPM, the measure that indicates how much additional expected return an investor demands for each additional unit of an asset's sensitivity to the market is the A. Beta of the asset, B. Asset's standard deviation of returns, C. Slope of the security market line, SML. An investor has $50,000 of her own capital. She borrows $30,000 at the risk-free rate and invests the total $80,000 in a broad market index fund. The beta of her overall investment portfolio is closest to A. 0.625, B. 1.000, C. 1.600. After a major acquisition, analysts forecast that Titan Incorporated's standard deviation of returns will increase from 25% to 40%. Its correlation with the market will stay at 0.6. Concurrently, the market portfolio's standard deviation is expected to rise from 18% to 22%. The risk-free rate is 5% and the market risk premium is 7%. Titan's expected return after these changes is closest to A. 12.64%, B. 14.58%, C. 16.82%. A security is plotted directly on the security market line, SML, at a point to the left of the market portfolio. Relative to the market, this security most likely has higher expected return and higher systematic risk, B. Lower expected return and lower systematic risk, C. The same expected return but higher unsystematic risk. Which statement most likely violates a key assumption of the CAPM? A. Markets are frictionless, with no taxes or transaction costs. B. Each investor has a unique estimate of expected returns for all assets. C. All assets are perfectly divisible and marketable. In the CAPM formula, the risk-free rate and market risk premium are constant across all assets. Beta is the only variable that differs and causes expected returns to differ. Option A. Form-specific risk, unsystematic, is diversifiable and not priced in CAPM. It does not affect expected return differences. Option C. Total volatility includes unsystematic risk, which CAPM ignores. Two assets with different standard deviation, but same beta have the same expected return. Beta equals price systematic risk. Form-specific risk, not priced. Total volatility irrelevant for CAPM expected return differences. Only beta matters. Negative correlation results in negative beta. CAPM, expected asset return equals risk-free rate plus asset beta, multiplied by market premium. With beta negative and market risk premium positive, the term is negative, which results in expected asset return less than risk-free rate. Option A, expected asset return equals. Expected market return requires beta equals 1. Perfect positive correlation, not negative correlation. Option C, expected asset return between risk-free rate and expected market return requires higher than 0, but lower than 1 positive, but low correlation. Negative beta is more extreme, pushing return below RF. Beta sign equals correlation sign, since asset standard deviation divided by market standard deviation is greater than 0. Negative beta assets act as hedges or insurance with expected return below risk-free rate. CAPM is forward-looking. Market risk premium is defined theoretically as the expected difference. Expected market return, risk-free rate. Option A, expected market return alone is incomplete. Premium is the excess over risk-free rate, not total market return. Option C, historical average excess return is a practical estimate for forecasting, but it is not the theoretical CAPM definition. Market risk premium is the slope of the SML, representing compensation for systematic risk. It is forward-looking by definition. Distinguishes three concepts: CAPM definition, forward-looking expected excess, expected market return, the total, and historical premium, backward-looking estimate. SML is the graph of the CAPM. Expected return, y-axis, versus beta, x-axis. It shows the linear relationship between expected return and systematic risk for any asset. Option A, CML plots expected return versus total risk, standard deviation, for efficient portfolios only, not the SML. Option B, SCL plots realized returns against market returns to estimate historical alpha and beta, not forward-looking expected returns. SML, expected return versus beta, any asset, forward-looking. CML, expected return versus standard deviation, efficient portfolios only. SCL, realized returns versus market returns, historical estimation. SML is for valuation or pricing, CML for allocation, SCL for performance measurement. Key distinguishing feature: SML's x-axis is beta, systematic risk. The SML represents equilibrium pricing, CAPM. A fairly valued stock's expected return equals the CAPM return, so it plots exactly on the SML. Option A, the efficient frontier applies to portfolios of assets optimized for total risk, not individual stocks carrying diversifiable unsystematic risk. Option C, the CML applies to efficient portfolios combining risk-free asset and market portfolio, not to individual undiversified securities. SML uses beta, price systematic risk, applies to any asset. CML and efficient frontier use total risk, applied to portfolios. Fair valuation equals SML question. CAPM equals 12.4%. Standard deviation, 18%, is irrelevant. Only beta matters. Beta determines expected return differences. Standard deviation measures total risk, but is not priced in CAPM. Market risk premium is the slope of the SML, common to all assets. Market risk premium equals 7.75%. Expected market return equals 4% plus 7.75% equals 11.75%. Standard deviations for all securities are irrelevant. Only beta of security Q matters for this calculation. Under CAPM, expected return depends only on beta multiplied by market risk premium, plus RF, which is constant. Higher beta equals higher expected return. Stock Z has the highest beta, 1.4, therefore the highest expected return, RF plus 7%. Stock Y has lowest beta, 0.9, lowest expected return. Standard deviation is irrelevant for CAPM expected return comparisons. Only beta matters. Despite stock Y having the highest total risk, 22% standard deviation, it has the lowest expected return due to lowest beta. Under CAPM, an asset's sensitivity to changes in expected market return is measured directly by its beta. Change in expected asset return equals asset beta multiplied by change in market risk premium. For a 1% increase in expected market return, asset R with beta 1.8 experiences the largest change, 1.8%. Beta determines sensitivity to market changes. Higher beta equals greater sensitivity. Standard deviation, total risk, is irrelevant for this sensitivity. Only beta matters. Homogeneous expectations mean all investors use identical inputs, returns, variances, covariances, leading them to calculate the same efficient frontier and identify the same tangency portfolio, the single optimal risky portfolio, market portfolio. Option A. Investors still have different complete portfolios due to varying risk aversion, different mixes with risk-free asset. Standard deviations differ across investors, so identical standard deviation is not a conclusion. Option C. The risk-free rate being the same for all is a frictionless markets assumption, not a direct consequence of homogeneous expectations. These are separate assumptions. Homogeneous expectations, same inputs, same efficient frontier, same tangency portfolio, market portfolio for everyone. This is the direct conclusion. Without homogeneous expectations, different investors would have different optimal risky portfolios, and CAPM equilibrium would be impossible. Homogeneous expectations equals single optimal risky portfolio, market portfolio. Heterogeneous expectations equals investors perceive different efficient frontiers, multiple different optimal risky portfolios, one for each unique set of expectations. Option A, a single market portfolio, as the tangency portfolio exists only under homogeneous expectations, not without agreement. Option C, differing expectations mean investors disagree on expected returns, so they cannot have identical expected returns. CAPM equilibrium requires homogeneous expectations. Without it, no single market portfolio, or CML, exists, only fragmented portfolios based on individual forecasts. Beta greater than 1, 1.20 means expected return, 9.7% exceeds market return, 8.5%. The calculation uses only beta, risk-free rate, and market return. Standard deviation is irrelevant. Beta less than 1, 0.90 means expected return, 8.5%, is less than market return, 9.0%, but greater than risk-free rate. The risk premium, 4.5%, is beta multiplied by market risk premium, 5.0%. The slope of the SML equals market risk premium, market return, risk-free rate. This is the additional expected return demanded per unit of beta, or per unit of the sensitivity to market risk. Option A, beta measures the amount of sensitivity, not the price of that sensitivity. It scales the premium, but does not set it. Option B, standard deviation measures total risk, which includes unpriced diversifiable risk. Not relevant for CAPM compensation. Slope of SML equals compensation per unit of beta. Beta equals exposure amount. Standard deviation equals total volatility. The question asks for the price per unit, which is the slope. Portfolio beta is weighted average using investors' own capital as denominator. Weighted market is total investment divided by own capital equals $80,000 divided by $50,000 equals 1.6. Weighted risk-free asset is borrowing divided by own capital equals negative $30,000 divided by $50,000 equals negative 0.6. Beta equals 1.6 multiplied by 1.0 plus minus 0.6 multiplied by 0 equals 1.6. Option A, 0.625 would result from inverting the ratio. Own capital divided by total investment. This is incorrect. Leverage or borrowing increases beta above 1.0. Option B, 1.0 is the unlevered market beta, ignoring the effect of borrowing to gain, greater than 100% exposure. Borrowing equals leveraged position, beta greater than 1.0. Lending equals conservative position, beta less than 1.0. The risk-free asset always has beta equals 0 regardless of whether you lend or borrow. Both firm SD and market SD changed, so beta must be recalculated using the new values. The market risk premium, 7%, is given directly. No need to calculate expected market return. Only beta changes, risk-free rate and risk premium remain constant. Always recalculate beta when either firm risk or market risk changes. On the SML, x-axis equals beta, systematic risk. Market portfolio has beta equals 1.0. Left of market means beta less than 1.0, which results in lower systematic risk. Positive slope means lower beta equals lower expected return. Option A, right of market equals beta greater than 1.0, which results in higher systematic risk and higher expected return, opposite of the question. Option C, SML plots only systematic risk beta, not unsystematic risk. Same expected return as market would require beta equals 1.0, not left of market. Left of market on SML equals beta less than 1 equals lower systematic risk equals lower expected return. Position on SML indicates fair valuation, not inefficiency. CAPM assumes homogeneous expectations. All investors have identical estimates of expected returns, variances, and covariances. Statement B, unique estimates per investor directly violates this key assumption. Option A, frictionless markets, no taxes or transaction costs, is a valid CAPM assumption, not a violation. Option C, perfectly divisible and marketable assets is also a valid CAPM assumption, not a violation. Homogeneous expectations is fundamental to CAPM equilibrium. Without it, investors would disagree on optimal portfolios, and the model's pricing mechanism would break down.